Hey everyone, chasing the lowest rate, but not actually saving any money on the mortgage. Stay with me because what I'm about to tell you might surprise you guys. Welcome back to the Closing Room AZ. I'm your host, Jesse Moreno, realtor and investor and coach. And I'm going to guide you through real estate through the whole game today. That is my job, is to educate you and just bring you the best guest on the planet here. This is part two of our three-part series with mortgage expert, Mr. Jorge Montano. Man, I don't know why I have a difficulty with your last name, Jorge.
Yeah,
I don't know. But anyhow, he's here with us today, and he's going to go and talk to us a little bit about our part two of our training today. He is with Cross Country Mortgage, and we are talking about the mortgage blueprint. If you missed part one, go back and watch it. He breaks it down. He breaks down mortgage and what it is. He talks about the loan types, and he walks you through the pre-approval process. It's some strong information, so make sure you go watch that. Today, we're going to dive a little bit deeper. We're going to talk about interest rates. We're going to talk about the closing costs, private mortgage insurance, and the mistakes that are costing, I would say, buyers thousands of dollars. So stick around, check it out. Make sure you take some notes here because it's going to be pretty exciting. Quick reminder, you guys, if you guys are seeing value in this show, please make sure that you hit subscribe, leave me a comment. Share with the first-time home buyer as well. If they need to hear it, that QR code that you see there will get you right to me. So take a picture of it, get my contact information. I'd love to have a conversation with you and help you out with any questions you may have. So let's go ahead and jump right into this. Back with me today, we got Jorge Montano. He is the, again, mortgage expert here with Cross Country Mortgage. And last episode, man, you were on fire. You broke it down. You shared a lot of great information. Today, we're going to be talking about stuff that really trips up the buyer in this process, which is our rates, which is cost, and mistakes they make, man, throughout that process when they're not working with the right folks here. So welcome back to the Closing Room, AZ, man.
Thank you, Jesse. Thank you for having me again.
Yeah, man, I am glad that you're here again, and we're going to be going into part two and breaking it down. I've got some questions for you, man. We're going to dive a little deeper into some stuff here. So, are you ready?
Let's go.
Yeah. All right. So here's my first question that my watchers are want to know, and they're just expecting to see what's going to come out of this, and that is, how do interest rates work, and what actually determines that rate a buyer gets?
Yeah, absolutely. It's a hot topic right now, right?
Yeah, for sure.
Let's talk about that. So at a macro level, the rate environment is driven by the Federal Reserve policy.
Yeah, absolutely.
Obviously, like inflation data, the bond market, and the 10-year Treasury, that's all correlated with mortgage rates, right? So when the inflation runs hot, the rates go up. When the economy slows down, rates go down.
Yeah.
Right. So that's typically what we see. And that's, just at a macro level. When we're looking at individual levels, so we're looking at specifically what the credit score is for our applicant. And that credit score obviously has a massive impact on determining whether they're going to get approved for the mortgage. And not only that, but also determining to some level what kind of interest rate they're going to get, right? So somebody that's at a 780 plus FICO score, their interest rate could look different than somebody that's at a 640 credit score, right? So definitely that does impact the rate, that you end up qualifying for. Sometimes even things like the loan to value, the loan type, we talked about in the last episode, conventional versus FHA or non-QM, these are all going to have different interest rates.
Okay. Yeah, makes sense. Gotcha. Cool. Hey, what's the difference then? Because we hear, we hear about fixed rates and we hear about adjustable rates, but what does that mean, or what's the difference between a fixed rate and an adjustable interest rate?
Yeah, great question. I mean, that's something that comes up a lot in our consultations that we have with clients, right? Should I go fixed? Should I go adjustable? Like, what are your thoughts? Because a lot of the clients that I talk to are like, well, I've always heard that getting an ARM, it's one of the worst things that you can do, kind of setting yourself up for foreclosure. And I'm like, no, just, pump the brakes. Let's look at it. ARMs are a little bit different than they were, what was this 15, 20 years ago when, ARMs did get a bad rep,
yeah,
but completely different now, right? We have the fixed rate. The fixed rate is going to lock in that interest rate for a set time. So it could be 15 years, 20 years, 30 years. So you're going to have the principal and interest payment is going to remain the same throughout, those 30 years. Things like your taxes, insurance, that's going to change, throughout the years, but your principal and interest is going to stay the same on a fixed rate. On an adjustable arm, you have the option to sometimes do a 5, 7, or 10-year arm. What happens is that you lock in a lower interest rate for that 5, 7, or 10-year period. And at that point, you're kind of just watching the market to jump in and maybe refinance to a fixed rate. But traditionally, the type of buyer that I deal with that is going to be interested in doing an arm is somebody who maybe they move a lot. Maybe their job is
Yeah, good point.
that kind of job where they're going to be here for maybe 3 years, 5 years. Makes sense. Take the lower rate and get the lower payment. For somebody like that, or just somebody who's looking for some flexibility in their monthly budget, that wants that lower payment.
Yeah, so true, man. I don't know how many conversations I've had with people, and they're like, "Hey, Jesse, I love this house. I want to make an offer," and then we start the process on the mortgage side, and they're like, "I'm going to go with the fixed rate. I just don't know what's going to happen. I just want to stay locked in. I feel so secure with the fixed rate
Yeah.
because they're not educated. They don't know the difference, right? Or perhaps the loan officer they're working with doesn't really educate them about the benefits and the features behind an adjustable rate. And you're right, man. I mean, there's a lot of people, they stick around for 2-3 years, and they're getting this fixed rate where the rate's much higher, where they could have got a lower rate because in 2-3 years they're relocating due to maybe their job,
Right.
they're in the military, who knows, different reasons. So if you're a buyer, and it's your goal is to be around for maybe 2-3 years on that property, and then move on to the next house, or you relocate and so forth, the adjustable rate seems the way to go. It's probably going to be the best rate, right?
Absolutely.
So, what is a rate buy down? By the way, because you mentioned earlier in our first podcast, and I don't know if our listeners remember, the ones that watched the first podcast, you said something about a 2-1 buy down, right? So, what is a rate buy down, and when should that be considered?
Yeah. So to me, I have the conversation with the client. So kind of similar to what we were touching on right now is how long do you plan on staying in that home, right?
Right.
Because that's really going to be a determining factor on if a buy down makes sense, right? And I know you mentioned this earlier too. The lowest rate isn't always the best rate or the best type, for your specific situation. So I have that conversation with clients, if we do a rate buy down. And by the way, if you're wondering like how rate buy down works, so for simple math, it's 1% of your loan amount, right? So if you have a $400,000 loan amount, 1% is going to equate to $4,000 in cost, right? So the way
That's the cost to buy down the interest rate.
that's correct. So
Okay,
that would be
gotcha.
the cost for that. So we would look at how much is that going to lower their monthly payment. So we take that number and we will look at how long it's going to take for that person to recuperate. So if you just invested $4,000 to lower your interest rate, what's your break-even point, right? At what point have you made that $4,000 back? And then it becomes savings after that point.
Right.
There's times where we look at it and their break-even point is 12 months, 24 months. Personally, I feel like that's okay, right? But if we're looking at 4 years, 5 years, 6 years to break even, it just doesn't make sense.
Right.
Because
good point.
now at this point, you probably could have gone that rate by just waiting on the market and not have paid the $4,000 that we're using, as an example.
Yeah, good point, man, for sure. I chuckle about it because, man, I don't know how many times people say, yeah, I'll do the I love the rate buy down. It sounds like it makes a lot of sense, but then they don't think about the break even point, right?
Right.
And they're like, hey, I'm gonna, I'm thinking about maybe just keeping it for a couple years and move on. I'm thinking, gee, well, if you're gonna pay X amount of dollars, you're probably not gonna recoup that in a couple of years,
Yeah.
right? And if you're 7-10 years, it might make some sense, but a couple of years based on the break even point, it may not make any sense, man. So it's
People like to chase the lowest interest rate.
yeah. I
Right.
mean, who doesn't, man?
Right.
Right. I mean, and nowadays the rates the way they are,
Yeah.
you're trying to get the best rate possible.
Which I don't blame people, right? 100%. I want the best rate for you as well. But what good is it if, like we talked about, the break-even point is not for a few years? It's just a trophy in the trophy case, right? Just displaying a lower interest rate, but people don't know how much you paid to get down to that interest rate. So, good point. And you touched on the 2-1 buy down, right? Which is another type of buy down that we do, and those are great as well. They're very similar to like an ARM. How that works. You would have temporary a lower interest rate. So say as an example, if you started off at a 6.5%, you can get down to about 4.5%, right? The next year it would adjust to 5.5%, and then eventually it'll adjust to the 6.5%
On the third year,
on the
correct?
third year, right?
Yeah.
So that is a great option again for that person that maybe doesn't plan on staying in that home for more than 3 years.
Yep. Absolutely, man. Thank you for sharing that because I wanted to ask you that before we jumped into our closing cost topics, man. And I was thinking, okay, I mentioned the 2-1 buy down, but we haven't explained to them what that means, and I'm glad you broke it down because if you're going to start off at 6% and you buy it down on 2-1 buy down, that basically could mean that your first year is going to be at 4%, your second year is at 5%, and then boom, you cap at the 6 year, at 6% on the third year, and then you're locked in for the remaining of your contract term, whatever that may be, right? And those kind of deals also work for those that are going to be on a short term. Hey, I'm just going to be here for a couple of years, you'll move out. I think the buy down might be the way to go.
Yeah,
absolutely. Might work. But again, man, I appreciate you breaking that down because for those that are probably listening and watching and saying, well, what is a 2-1 buy down? And there's 3-1 buy downs, right?
There's also 3-1
I think I
buy
saw
downs.
something like that not too long ago. I don't know which lender or maybe it was you guys. I don't know.
We offered 3-1 buy downs
was it?
as well. Yeah.
Okay, that's where I saw it, but I was like, 3-1 buy down's crazy. Okay.
Yeah.
That
So
could
just
work.
imagine getting back into the threes. Like now that's a rate that, if we got you into that, that's, that's going to lower your payment a lot. But you have to also know that by, year 3, your payment's going to start to go up. So.
Let me share this with you guys, man, so you guys are on the same page of my mentality of how I look at interest rates, because I work with a lot of buyers, and I'm looking for people looking for properties, and I just let and the way the market is right now, the rates, you guys know today's date. Today the rates are high. I mean, they spiked today. What are we at today? Today's what, the 20th. The rates kind of spiked today. It was kind of like, what's going on in this market, right? But I tell people this: listen, man, don't panic about the rates. Rates are always going to fluctuate. There's a saying in our business, and you guys probably already heard it, or maybe not, I don't know, but it says, date the rate, right? Marry the home, right? Basically what I'm saying is when you date the rate, you could always refinance it down the road. You could always do something else, right? To lower that interest rate when the time comes. But the home continues to build equity, cash value, it continues to grow in value, man. So why wait? If you end up waiting for the rates to drop, and this is my opinion, but when you continue, if you're thinking about waiting for the rates to keep dropping, the offset is the property still is going up in value.
Right.
And so by the time the rates may drop 0.25%, 0.5 point, but the home goes up $40,000, $50,000, man, that payment's still going to be higher than it would have been if you would have got the rate that is now.
And you have a higher balance that's going to affect your.
And you have exactly, a higher balance.
So no, I'm with you on that as well. I think
Right.
that the moment that you are able to get approved for a mortgage loan, that's at the time that you should jump into home ownership, right?
Yeah.
Because just like everybody else is waiting on the sidelines, waiting for those rates to drop. And like you said, 0.5 point. I mean, it's not a huge drop to wait and pay $50,000, $60,000 more. And not only that, now you're competing with other buyers, right? So the same home may have 3, 4, 5 offers,
Right.
versus now, we're in a market where sellers are helping with closing costs, which, I know we're going to get into here shortly, but that's another reason, to jump in the market now.
Yep, absolutely. Absolutely, man. Word of advice to you folks, listen, if you're a renter, if you're renting, don't procrastinate, man. Let's get you into a home. And let's not making the landlord rich, and let's make you rich now by building some equity in your pocket, by being a homeowner. I don't know what else to tell you then. Don't wait for the market to change. This is what it is in our economy. But if you're looking to buy a property and you're in the market to do that, don't play the market, man. Get into a property. Talk to a realtor. Call me, right? There's my QR code. Hit me up. I'd love to help you out. And when it comes to the mortgage lending piece of it, reach out to Jorge here, right? Let's figure that out. You may be surprised. You may be thinking, hey, maybe I don't qualify and my credit, blah, blah. Let the experts tell you if you qualify or not, right? Stability, if you have it, if you got a job, you've been there for a little bit of time, you got some reserves, you maybe got a little bit of money saved up. And if you don't have the money saved up, man, make you do a gift. There's so many different ways of making things work, but you got to reach out to the lender. We got to reach out to you, right?
Yeah, just have the conversation. And I know that's probably sometimes the hardest piece, right? Is somebody wanting to sit down in front of somebody.
Yeah.
This person's just going to look at their financials. They're going to be judging based, on mistakes maybe I made in the past, or
Absolutely.
we've all been there. I mean,
Yeah.
I don't like going to the doctor because I know that the doctor is just going to say how bad I'm doing, right? So I get it, and that's what I tell people when they come in. Like, we're going to sit down, we're going to look at this. I look at hundreds of reports a year. I am not going to judge you. I'm not here to judge you. I'm here to help you, get you to that next step.
Yeah, for sure. Well, listen, man, me and Jorge, we want to help you guys out. So don't procrastinate. Reach out to us. If you're looking to purchase, looking to refinance, or whatever it may be, or any of your real estate needs or questions, you got to reach out to us, man. We would love to help you guys out. All right. Like I said, we're going to talk a little bit about closing costs, right? So let's jump into this one here. Closing costs. What's actually included in a closing cost, that a buyer should be aware of?
Yeah, good question. And that's something that comes up right in our consultations is, so there's down payment and then what's this closing cost, right? A lot of people get confused on what closing costs actually are. So we'll break that down. Typically, closing costs, it's going to be anywhere between 2 to 5% of the loan amount. So as an example, if we have a $350,000 per home purchase, that's going to be about $7,000 to about $17,500 on top of the down payment. So it is separate. Some of the things included on here is going to be your third-party fees. This is going to be things like appraisal, title insurance, settlement fees, recording fees, so your title fees, right? You're also going to have your lender fees on there as well, right? So like our processors, underwriters that work on the loan,
Sure.
This is all part of the fees that are included in there. You'll have your prepaid items, so you're typically going to pay the first year of your homeowner's insurance upfront, prepaid interest, and the initial escrow deposit for the property, right? So one thing that some people mix up is they come talk to you, right, Jesse, and they're like, hey, I want to buy a house. And I've heard about this earnest deposit, right, which is typically, what is it, about 1% of the purchase?
1%, between 1% and 3%.
1% and 3%.
Yeah, I mean, the higher the percentage of down payment that they put down as deposit, the better it is. In my, again, I'm now speaking to you as the realtor,
Yes.
but the bigger earnest deposit, the more buying power you're going to have of acceptance of your offer. But yeah, 1% of the purchase price is going to be norm.
Yeah.
Absolutely.
And people will ask me, like, so is that a separate fee? No, that's going to go towards your closing costs, right? So let's just say once we balance out your closing costs, if it was $20,000 as an example of closing costs, and you gave a $3,000 deposit, well, that's already $3,000 of the $20,000, so $17,000 is what's owed. So you're not losing
Sure.
that money. It's not a deposit that you're giving to the seller, and I have heard some people that get confused by that term.
Yeah.
So just wanted to clarify that. But that closing cost can be negotiated, right? So when you reach out to somebody like Jesse, great negotiator, knows the Phoenix market, and we know that right now, sellers are wanting to move on these homes, and they are willing to pay what we call seller concessions, right?
Yeah,
So
absolutely.
that could be 1% up to 6% in concessions.
Right.
So if you're kind of following my drift here, if somebody offers 6% concessions and we only need 2% concessions to pay your closing costs, we have basically 4% of that purchase price to maybe buy down your rate.
Yeah.
A lot of different ways that we can slice
Yeah,
that.
good point for sure. Yeah, man, good stuff, dude. This is gold info here, you guys, man. And I hope you guys are taking notes, and hopefully you brought someone on the, to sit next to you and listen to this conversation, because this is good stuff here. It's semi basic for the most part, and again, also a little bit high level. And we're not diving deep into it. I know Jorge's not diving deep into all these things here. He's giving you more of a high level part of it. But the catch is this, man. It's to reach out to him so he'll go ahead and give you a little bit more in depth of that information, so that you're fully aware. I mean, that's the name of the game for us, right? Is let us educate you and help you as much as you can, so that you guys are prepared for your purchase or for your refinance. And what's another better way of doing it than just reaching out to a mortgage expert and get that information? We're not the car salesmen, and we're not the bad guys here. It's just conversation. It doesn't cost you a dime to just have that conversation. And that's why I really implore and encourage you to do so, especially if you're a realtor, man. This is the time, not a realtor, but a renter is the time to do it. It's the time to start looking for a property, and get with Jorge, because he'll tell you, hey, based on your information you're giving me, here's what you qualify for. And then boom, you connect me to me, right? The realtor, and I help you out with that. All right, we're going to jump into a few little acronyms here. So not to confuse you, but I'm gonna let Jorge break it down for us. But Jorge, man, what is PMI and how do buyers get rid of it?
Yeah, good question. So, PMI stands for Private Mortgage Insurance, and that's required on conventional loans when the down payment is less than 20%. So, again, that's to protect the lender, right? It's not protecting you, it's not home insurance, it's insurance on the actual mortgage.
Okay.
Uh, so typically that's about 0.5 to 1.5% of the loan amount per year. So as an example, on a $350,000 loan, at 1%, that's going to be about $292 a month that's added to your payment. So you have your principal, your interest, taxes, insurance, and then you would have your PMI. So in this scenario, we're looking at like 292. How can you remove it? Once you have reached 78% loan to value, so the original appraised value of the property, and you reach 78% of that, you can request a cancellation at 80% actually with most lenders. Sometimes they ask for an appraisal, in order to get rid of the
Sure.
PMI, but you can remove it with conventional. Now, FHA, it's called MIP. MIP is a little bit different. So we talked about, if you put less than 10% down, that mortgage insurance is going to stay for the life of the loan. So no matter what your loan to value is, you could be at 60% loan to value. You're still going to have the MIP with FHA until you refinance to a conventional loan.
All right. MIP, mortgage insurance premium.
Yes.
Yeah. Okay. Just wanted to throw that out there so you guys know as we're giving out these acronyms. We know that PMI, private mortgage insurance, MIP, mortgage insurance premium. Mortgage insurance premium, just I'm not confusing myself, goes with FHA. PMI goes with conventional financing. All right. On MIP, I said PMI, MIP, it doesn't come off on an FHA, you guys. Even if the only way it's going to happen is if you refinance it.
Right. You refinance it.
And you're under 80% at that time.
Correct. You have to be under 80%, refinance it to conventional.
Right. But if you don't refinance and you're like at 50% loan to value, it's going to stay on until you do something about it.
That's correct.
All right. Makes sense. You guys got that? I hope you guys got that, because if you didn't, you need to rewind this and listen to it again or reach out to Jorge here. All right. Let's talk about the biggest mistakes buyers make at this point, right? What's one of the most costly mistakes you would say buyers are making during the mortgage process?
And I think we talked about this in the previous episode, but making big financial moves during the process.
Okay. Yeah.
That's one of the huge mistakes. You don't want to go rack up your credit cards, max those out right before closing. I know it gets exciting. You got under contract. You're going to move into this new, beautiful home.
Let's go buy new furniture now.
Buy new furniture. It happens.
Happens all the
We're
time.
talking about it right now because it happens more often than, we
It
like.
does. Yeah.
So that's something important for you to know, is that during that time, just kind of pause everything on credit, right? We are guiding you through it, but we just ask that you don't make any big financial moves, which that could also include a job change, right?
Yeah. Yeah, for sure.
Don't change jobs in the middle of a transaction. Sometimes, you can go from being a W-2 employee to 1099 or vice versa. And now all of a sudden we can't count if you were working, say, overtime at your previous job. And that's really going to take a hit on your pre-approval amount, right? So that's huge. And also another thing that I noticed is people who like to just rate shop, right? They want to just go with the lowest rate.
Right.
We've been touching on this. It costs money to get to the lowest rate, right? So all the lenders, we all are going to have about the same interest rate, right? I start questioning, if it's more than like 0.5% off from, where we're at and somebody else is at. I start questioning, what are they doing to get you to that interest rate? Can we look at the breakdown on your loan estimate? How many points are you being charged?
Right.
There's your surprise. They're charging you 3 points to get to that rate, but maybe they didn't disclose that, right? And again, I get it. When you don't have an expert on your side, or somebody that's truthful and looking out for the best interest in you, that could happen, right? And you can make the mistake of signing on a loan like that and not knowing that your closing costs just went up, an extra 15 grand,
right?
Because you agreed to that rate buy down.
Absolutely.
So shopping at the lowest rate, not always going to be the best for your loan. And also like not understanding what your full monthly payment is. We broke down, what MIP is, what PMI is, your taxes, your insurance. And then also, if you're buying a property that has HOA, you also have to pay the HOA dues,
Right.
right? So that's not going to be included in your monthly mortgage payment, but it is part of what you're going to be paying out monthly. So understanding
Right.
the full picture of what you're actually expected to pay monthly to keep your home.
Yeah, absolutely. I don't know how many times, man. I've, the buyers are like, "Hey, Jesse, so my payment's going to be, $2,000 principal and interest." Oh, fantastic, right? They're comfortable with it. They're like at budgets, right? And then they get the realization that it's not just that as well. Now we got property taxes, right? We got home insurance, right? We got, if it's an HOA property, the HOA fee, and these HOAs, man, they go from $70 a month to $1,000 a month, depending on where you're at. I mean, it's crazy, right? So you got to take into account all these things before you start celebrating, thinking, the payment sounds easy enough, or I qualify for this, whatever the case may be, right? So it's knowing the full story. So those are three good mistakes people make, man, and that you need to be aware of for sure. Anything else on those? Sounds pretty. I mean, those sounds pretty good, man. I mean, that's a lot
Yeah.
of info.
Yeah, no, I think, I mean, when we really look at the big picture, I think those are probably the bigger mistakes that
Yeah.
I see, people doing.
Yeah, good point, man. Thank you for sharing that. For sure, I'm with you. I think one of my last questions, we're going to wrap up this particular series, which is part 2, and then we're going to get into part 3 here in a bit. But what do you wish, man? What do you wish every buyer knew before they started the process?
Truthfully, that they would speak to the lender first.
Yes.
I say this
Agree.
because, and I get it, there's with TikTok and Instagram and, everything that's out there now, you're seeing a lot of these like property tours that realtors, are doing, and people fall in love with these houses that are 700, 800,000, and sometimes that could be out of somebody's budget, right? So worst thing is having a conversation with somebody that wasn't prepared, and they didn't know what their budget was, right? So for me, ideally, I would want that person to speak to me first. Let's go over budget. Let's go over expectations, maybe even monthly payment, right? Because some people could get payment shocked by looking at their dream home, what that actually is going to cost monthly. So I think speaking to a lender, setting that expectation, this is where you want to be at monthly. This is what you should be shopping for. So that way, when I send somebody over to you, they already know the expectation. They already know when they're going to be looking at a home about how much that monthly payment is going to be. And there's not that, payment shock of, I thought it was going to be a lot lower than that.
Yeah. Well, all right, for sure. Hey, what is the best way to reach you?
Yeah, best way to reach me is going to be my phone number, 520-350-5090.
All right, easy enough. All zeros.
All zeros.
All right, and all that information as well is on my podcast. So you guys could just click on the bottom and you'll see it. You'll see his information. Quick way to get to him. Dan, Jorge, incredible episode, dude. A lot of great information. I mean, you broke it down. We talked about rates, how they actually work, the real cost of closing, your closing costs. We talked about PMI, private mortgage insurance, and how to get rid of it when we need to get rid of it, right? How to ditch it. We talked about the 3 mistakes. He came up with 3 mistakes that are quickly killing deals. I mean, that's all great information you're able to share with us, man. Thank you so much. In the next part, next time we're going to get into part 3, which is our final episode, we're going to talk about what happens when you go under contract, right? We're going to talk about the appraisal. We're going to talk about the underwriting, and then what could kill a deal, and then how to set yourself up for a smooth closing. So you guys don't want to miss it. So make sure you guys come back to part 3 and hear it out, because we're going to end up with a bang on this one. And it's just going to be some great information. Again, as always, please make sure that you subscribe to my channel so you guys don't miss anything. Most importantly, that way you guys can catch up on podcast or part 1, part 2, and of course part 3 when we hit it up here in a bit. Drop me a comment if you guys have any questions, man. Reach out and let me know what your biggest takeaways were when you guys were listening to this podcast, man. I love to hear your thoughts. Any feedback you have, man, is greatly appreciated. Hit that QR code that you see there. It's going to get you directly to me. I'm always on the lookout for any information that comes across. So I promise you, if you hit that QR code and you have any comments, you reach out. I'll get back to you and let hopefully I'm here to help you out when you're ready for your next purchase. And of course, connect you to Jorge Montano here. Love for you guys to work with him, and he could help you with all your real estate mortgage needs. So don't forget, you guys could find me on Instagram and Facebook under the Closing Room AZ. Hit me with the DM topic. I'd be more than glad to check it out and see what I can put together for you. If you have any questions, that's the best way of doing it as well. If you just want to say, hey, what's up, Jesse? How you doing? As well, I'm always listening. I'm always there. So please make sure you do that. This is the Closing Room AZ, where real conversations happen all the time, where you get real results all the time. Thank you for being here, you guys. Have a blessed week. And remember, set no limits.